What's happening, y'all? We're gonna do the portfolio update. I'm doing it a little early this week. I'm doing it on a Saturday because tomorrow I got obligations, right? So I'm getting it out the way early. I'm gonna go through how I look at the economy. We're gonna look at my portfolio a little bit, but I wanna do an economical assessment with y'all so that way we can walk through and see where we expect the market to be going, right? So we know this past week the market has had a lot of volatility. Let's look at the fear and greed index, right? So with the fear and greed index, you want to be fearful when others are greedy and greedy when others are fearful. So currently with the fear and greed index, we are fearful. The other like Thursday, we were in extreme fear and now we're in fear. So since the market is fearful, usually you want to plan for the market to go up after. But this is just a fear and greed index. This isn't a tell-all situation. So you want to take it into consideration, but not base everything off of it. So when there's fear in the market, we can soon expect the market to go up. But that's all that tells me, right? So as far as the long term and short term bond yields, let's look at those. So I asked ChatGPT, is a 10-year US Treasury note, is the interest rate on a 10-year US Treasury note higher than the 30-year? And it is not. When short-term US Treasury yields are higher than longer-term US Treasury yields, that's a bad sign for the market. What that is called a inverse yield curve. Right now, the yield curve is still with the 30-year US Treasury notes being longer than the 10-year US Treasury notes, which means that's still a good sign for the market. Our 30-year is higher than the US than the 10-year. So that's good for the markets. So that's fear and greed index. That's U.S. Treasury notes. Let's look at. There's not too much economical stuff coming out next week. Next week because of the government shutdown. But we do have CPI. What's that on Friday? We do have CPI on Friday, but it may be delayed because of the government shutdown. We don't have to worry about any government news because of the shutdown, right? So fear and greed index give us the market should be going up. The bond yields tell us that the market could still be going up as well, right? Let's look at how does the market move after a government shutdown. As y'all can see, I use everything to my advantage when it comes to assessing the market. So as the US government shutdown can affect the stock market, the impacts depend on the factors like length of shutdown, economical conditions, and market sentiment, right? So it looks like short term, there's initial volatility. We've seen volatility this week, modest dips. Historically, stock indexes like the S&P 500 drop slightly, maybe 2%. Medium to long term reaction. This is what happens. Past example, during the 35-day shutdown, the S&P actually rose. So the government shutdown really doesn't have much effect on the stock market, right? So now let's get into the charts. Let's get into the charts so we can see what they talking about. Well, first let me have let me have perplexity um, give us what we think the market is going to do. So put based on bond yields, DXY, which is the US dollar, the fear and greed index, the up and coming Fed rate cuts, and the MACD on VTI on a daily time frame. What direction do we expect the market to go next week and for the remainder of the year? Right. So let's see what perplexity is talking about in regards to the market. All right. So based on current US equity market looks modestly bullish into next week and potentially choppy, but upward bias through year end. Okay, so we have the yield curve on bonds is still what it needs to be. We got some rate cuts coming. The Fed wildly expected to do a rate cut in October. We know that. Bond yields, let's see, the bond yields have declined over the past 2 weeks as traders price in aggressive rate cuts. Falling yields typically boost equities and pressure the US dollar. The US dollar is softening slightly. So when the US dollar goes down, the market goes up, right? VTI, the MACD line crossed above its slight signal, uh, reinforcing short-term bullish momentum. However, the RSI reading near overbought levels. So if we look at everything all together, the Fed rate cut bullish, bond yields bullish, dollar index bullish, fear and greed index mild bullish, and short-term upward momentum. So according to AI, it looks like the stock market should be bullish next week. In summary, the trend remains upward heading into next week and year end, driven by rate cuts, optimism, and softening yields. But short term volatility may spike a sentiment because of stretched highlights in the Fed decision. Another reason why I am in favor of the market going up is because this past week we did have the banks report earnings, right? We did have the banks report earnings and they crushed earnings. All of them did pretty good in earnings. Bank of America, Wells Fargo. If I could share my screen with y'all, we could look at Bank of America's earnings on Robinhood. So if y'all see Bank of America Q3 earnings was way higher than last year and way higher than expected. So when the banks are beating earnings, that is a sign that the economy is doing well, right? As you can see over here, the lighter dot is what they expected, the one that's more faded, and the higher one up is the where they actually what they actually did. So they beat earnings significantly. All of the banks, Wells Fargo, this is Bank of America, but all of the banks beat their earnings, which means that the economy is doing well. People are still taking out loans, right? So since I already have that pulled up, let me pull up the portfolio for y'all real quick. So looking at the portfolio, we got 12.5 shares of Nvidia. Let me share this with y'all. 12.5 shares of Nvidia. We up $500 on Nvidia. Nvidia is 55% of the portfolio. Intend on increasing that just a little bit. Just a little bit. Just a little bit. Gold has been going crazy. Let's look at gold. Good Lord. I'm telling you, if you did not have gold in your portfolio this year, and gold, go back and look at my other videos. Gold is one of the first ones I picked up. But gold year to date is up $30, up 60%. The market only gives you 12%, right? So that's the portfolio. We still beating the market. But now I'm gonna show y'all the chart just to get some confirmation on what do we think what direction we think the overall stock market is gonna go, right? So this is on the daily time frame. And looking at the daily time frame, the market is giving me bearish momentum. And when we say bearish in reference to the stock market, we mean like the stock market to go down. And the reason why I say it's bearish is because one, The MACD is still red. This one that I'm making larger and smaller, you read the chart from left to right, and if you look all the way to the right, the MACD is red. The blue line has not crossed above the orange line yet, and the bars are still red at the bottom. So that's one reason why I think we should be going down in the stock market. Um, Everything else is telling me we going up, but looking at the chart, it gives me caution. One, this super large red candle. I feel like that's a signal of where we could be going. The MACD is almost red. Is also red. Another thing I'm looking at is we look like we have a inverse head and shoulders pattern, right? So I'm gonna show y'all what that looks like. Or my bad, not an inverse head and shoulders, but a head and shoulders pattern, right? So when it comes to patterns, they ain't always got to be perfect. But let me show y'all what I'm looking at. So take a look, screenshot at what this is. Then we're going to look at the head and shoulders, right? And the head and shoulders is a chart pattern. So you have, let's see. So you have shoulder, head. Let me make sure y'all can see what I'm looking at. So shoulder, head. And when it is a confirmed head and shoulders is when it breaks the neckline. So either where that line is or somewhere up in here, you know what I'm saying? Either here or here is where you could consider the neckline for the head and shoulders. So if we break below these lines, we're going down. If we break below these lines, we're going down. Also, I got the moving averages up here. I got the 20 to 50 and the 200. 20, 50, 100, and 200. You can't see the 200 on there. But when the shorter term moving average crosses below the longer term moving average, which it looked like it's doing, let me show y'all. The shorter term moving average right here literally just crossed. Hold on, let me get rid of that. The shorter term moving average literally just crossed below the longer term moving average. So everything really is geared towards the market going up, but the chart is telling me that the market could go down. So approach with caution, right? I'm gonna pull back up the chart to let you know when there's confirmation. So when we break this consolidation that we're in, right? Once we break the high, that's confirmation that the market is going up, right? So we don't have confirmation yet. But if the stock market breaks 332, right now it's at about 327. The stock market breaks 332. Let me pull the chart back up. But if the stock market breaks 332, we have a confirmation that we are still going up, right? And that's where I got that purple line at the top, 332. So if the stock market breaks 332, we got confirmation that we're going up. Everything looks like we should be going up, but the chart tells me that we should be going down. This is the third quarter, the best performing quarter in the stock market. So usually the last 3 months are the best performing months in the market. So I take that into consideration. Everything is looking good from here, but I am approaching with caution. I'm Mike the Money Motivator, man. Y'all make sure y'all like and subscribe.